Thank you all for signing in and being a part of this webinar. We've got a great presentation ahead to go over the Houston PFC Portfolio Investment. My name is Doug Earthman with 2D Investments, and I have my partner Mickey Bernstein here, as well as Craig McGrouther with Lone Star Capital, who's going to walk us through the Houston PFC Portfolio Investment. I do not want to take up too much time at the beginning, but first I'll introduce myself. Again, my name's Doug Earthman. I founded 2D Investments. I'm a married father of two. I live in Germantown, Tennessee, graduated from the University of Mississippi in 2010 with a bachelor's degree in geological engineering. I still work in the engineering field. In the industry, which I believe has given me a very unique perspective into real estate and development on the due diligence side of things. I will go over some more about, 2D Investments, but I will turn it over to my partner, Mickey, to tell you a little bit about himself. Mickey.
Hello, everybody. I'm Mickey Bernstein. Most importantly in my life is my precious wife, Diane, 7 adult children and 14 grandchildren. I'm an exercise addict and have that in common with Doug. I have 40 years of cosmetic dentistry experience, and then I retired and I've worked as a business consultant. I'm a past president of the American Academy of Cosmetic Dentistry, and I served on several boards. Most importantly for tonight's program, I've been investing in real estate and development for most of my adult life. And it's been really fun for me, including rental houses and beach condos and multifamily limited partner, and developed an industrial park. I consider myself a rainmaker to help others reach their goals. And I'm honored to be here. We always vet the developers we work with and feel particularly confident about Lone Star, having met with Craig and Rob and Dasha multiple times and traveled to Houston to tour these properties in person. So these are our kind of people. We always invest in every property we offer to our clients, but this time we're personally making a much larger investment. I've gotten to know our guest tonight, Craig McGrouther, who will detail this exciting investment opportunity shortly. Doug?
Yeah, and a little bit about 2D Investments first. So I started 2D Investments as a way for myself to get into real estate investing, and it turned into much more. That was years ago, just as an investment vehicle. And as I got further and further into it, started participating in investments, I was blown away by the amount of people that don't know about these investment opportunities. I had just found out about them, and no one I knew had any idea they existed either. So I started seeing a gap that really needed to be filled. There was this disconnect between intelligent, hardworking professionals and these extremely lucrative private real estate offerings. I felt like it was my duty to spread the word about them, which is why our platform aims to help educate potential investors about these offerings and then provide a platform with these opportunities. So we do all the heavy lifting of finding the investments, negotiating investment returns, vetting the operators and the investment opportunities themselves. And then we have an extremely user-friendly portal where you can do everything from looking at your look at upcoming projects, reserve a spot in the project, commit to the investment, sign legal docs, fund the project, receive distributions, all through the portal, where it's tracked for everyone's convenience. So the days of spreadsheets and files on your computer are over. Your accountants will greatly appreciate it. And it's just a really easy, streamlined way to invest. Now I'm going to turn it over to Craig with Lone Star Capital, who's an incredible guy, brilliant operator in the real estate space. And we're so excited about partnering with him and everyone from Lone Star Capital. And along the way, if you have any questions, throw them in the chat and we will either answer them during the presentation or at the very end. And Craig, take it away.
Yeah, thank you so much for the warm introduction. Can you hear me?
Yep.
Excellent. Yeah, thank you so much. And thank you to everyone who came here tonight. I appreciate it. I didn't even have to ask anyone to mute themselves. You guys preemptively did that. So a veteran crowd here. Appreciate you guys doing that. And as Doug and Mickey mentioned, if you should have any questions, feel free to put them in the chat as we go along. And we can kind of answer them there. But yeah, without further ado, my name is Craig McGrouther. I'm the Director of Business Development here with Lone Star Capital. Essentially, my job is new relationships, nurturing relationships and kind of growing them out and kind of working on the cap table, doing a lot of the outbound work. So I work hand in hand with Rob Beardsley. Rob is one of the co-founders of Lone Star Capital. He's written 2 books on real estate related, on underwriting and then structuring debt and equity with real estate. Currently, we're a Texas-based sponsor. We're vertically integrated. We've been in business for 5 years. With that said, we've gone full cycle on 2 properties. We only want to be in Houston and in Dallas. So as Doug and Mickey said, they were with us about a couple of weeks ago, was it now? Maybe a month ago in Houston to view this offering. I think they fell in love with the property as much as we did when we first saw it. So it's always nice to work with folks who had boots on the ground, took the initiative to come out and visit it and know what they're talking about, and then also putting their money where their mouth is in reference to not only raising for it, but most importantly, investing on it as well. So that's why we're all here.
So really quick, I'll dive into a little bit about how we got involved with Lone Star Capital. Like Craig said, the founder of Lone Star, Rob Beardsley, has written 2 books, and I actually have both books right here. They're incredible. And I reached out to Rob to talk to him about his books, and we stayed in communication since then. And I started seeing their projects, their newsletters, and some case studies over the course of the past year. And they've been one of those groups that has checked all of the boxes for us. As an operator, they have the track record, they have the experience, they have some just incredible projects, and they know what they're doing. But it's not that easy. Like, we don't just get to say, hey, these guys are rock stars, we want to work with them. They deal with a lot of institutional investors and family offices. So not anyone can just partner with these guys on a project. We've met in person on numerous occasions. We've sent a lot of emails and had a lot of Zoom calls in the process of really vetting each other and making sure that it was a good mutually beneficial fit. And this relationship has allowed us to get our investors into institutional level investment opportunities. So we're really grateful for that and having the opportunity to work with these guys.
Yeah, no, and to piggyback off that, Doug's absolutely right. We're really flattered when anyone wants to work with us, of course. With that said, it's a 2-way street like any relationship. So we definitely want to make sure we're feeling as if we're working with the best of the best, especially when we're working with a new capital partner. On our end, you always want a balance of new partners and recurring partners and referrals. So it's nice to have continuity in there. And we look forward to, most importantly, not just doing one deal with this team here, but multiple deals and maybe, at least once a year, hopefully, and moving forward where everyone's comfortable. You guys know what to get from us, you know what to expect. You like and appreciate our communication. in our performance and operating on the property. And yeah, we don't want to just work with anyone. We feel as if we're the best of the best, and we want to hold we want our partners to hold up the other side of the bargain. And we feel as if Doug and Mickey are the fit for that. So we look forward to building out the relationship and working forward on this one. Shall we get into it, Doug?
Let's do it.
Cool. Awesome. So a little bit about the investment summary. And as we said too, just before I get into it, if someone has a question, feel free to let us know. So with that said, without further ado, here is the summary of the investment. So Lone Star Capital, the group here, is under contract on a 3-property portfolio in Houston, Texas. It is 666 units in totality. There is Beckley and Highland, which is garden style, 1999 to 1994 vintage, and Meritage, which is 2008 podium build vintage properties. So all in all, these are likely the best properties that we're going to have in our portfolio when we close on them. I mean, they're absolutely immaculate. As you can tell right here, the purchase price for the properties itself is 110 million. And then CapEx is only $13 million. I don't know if you can see my cursor right there. Can you see that? Cool. So $13 million in CapEx. As you can tell, the loan is that amount right there. So not a ton of capital being put in there because the properties are so immaculately maintained. So that's incredible. Essentially, the value that you're getting on this property is the PFC implementation into this property. What is PFC? PFC is a program. It's a statewide initiative in Texas called the Public Facilities Corporation. What it allows is for 100% tax abatement on the property in exchange for some very mild, modest rent restrictions. So 60% or 20% of the units, need to be rented to the folks who make 60% of the area median income. And 30% of the units need to be rented to folks who make 80% of the area median income. And then the other 50 are market rent. So in exchange for these modest rent restrictions, we get 100% tax payment, which is overall very beneficial, as the numbers will show as we kind of slide through. We're really lucky and fortunate to be able to pull off such a move, because not every sponsor in Texas, just because they are there, are allowed to be in the program. For 3 years, the other key principal, Kent, who was a senior tax attorney for over a decade with MetLife, has been kind of going on a chase to work with the right consultants and lawyers to get that taken care of. And now, through the long process, we finally have the right team on our side who will allow us, enable us to get into that program. So it's absolutely amazing and exciting. So yeah, we'll get on to the specifics of that. Real quick, firm profile. Here's the team. As Tent and Rob are the principals. Charles is the director of acquisitions. Josh, asset manager. Brad works under Josh. Dasha and myself are on the investor relations side. And of course, Doug and Mickey have met with Dasha and myself many, many times, as well as Rob. We are a vertically integrated a sponsor. So we have our own in-house property management, Radiance Living, which is incredible. This is really more for the investors, more than it is a money-making endeavor for us. Most importantly, we want to have reporting first class and speed, and also we need to have aligned interest with our group, so and our investors and whatnot. So Aaron Petrie is the VP of operations for that and works hand in hand with us, and we do not do any third-party management for anyone else. This is solely for the operations of our team. So just real quick on case studies, we've gone full cycle on 2 properties. Verandas of Bear Creek, which, as you can tell right here, had a 35.9 IRR, which is pretty impressive. You can tell right here how that was done. I'm not going to spend too much time on this, but a really impressive full cycle story here. And we do also have a due diligence room, which Doug and Mickey can share if people kind of want to dig deeper into that. Additionally, Cranbrook Forest right here was another exit that we had, which ended up netting 23.9% IRR to investors as well. Here's some testimonials. And then, as mentioned, here are the 11 properties we have under management. Here are the 2 case studies. So Beckley and Highland, as mentioned. So these 2 properties are purchased at $66 million, excuse me. As you can tell, occupancy is really great on these properties. I think Doug and Mickey can agree, when we're at these properties, there was essentially 0 deferred maintenance on these. So there's about 50% of the units that will be renovated over the course of the hold. The great thing about Beckley and Highland is that these properties are not only extremely well occupied, very little deferred maintenance, but the building vintage is great as well, which goes to the lack of deferred maintenance and the issues we're going to have over the course of the ownership here. But the great thing is that it's also in an amazing submarket. So it is in a submarket that is the 2nd best school district in the city of Houston, which is incredible. So as we have a lot of 2-bedrooms and 3-bedroom unit mixes inside Beckley and Highland, that's really great for retention and just overall the area and the reputation of the property. So as you can see, occupancy is great here, and we will go through to the next. So the business plan for this, as I said, is to do some the business plan here is simple. It's just to do some unit improvements. And then also one benefit we get is these properties right next door to each other is the economies of scale efficiency. So because they are basically bordering, as Doug and Mickey remember, we get the benefit of having management and the fees there being great, and also sharing some payroll, as well as having the leasing offices kind of working in tandem together, so they can work hand in hand, and which is really beneficial. And then another thing you can see right here too is just the LTC on the offering. It's pretty amazing. So a lot of deals right now, due to interest rates being so high, it's really hard to get leverage. Due to the PFC component, the Public Facilities Corporation component of this offering, we can get max leverage because the lenders will underwrite our NOI with the tax abatement gone, where we can get full leverage. So if you're playing the bonus depreciation game as well, you'll be able to get more bonus depreciation on this property too. So I'm not going to go through the investment returns here necessarily, because this is kind of the blended 3 together. The property overview, as you can tell right here, part of the business plan is, if you see the top left picture, that's what the original units look like. What we're going to do is change it to what this looks like right here. As you can tell, better cabinetry, the better countertops, as well as the luxury backsplash, the stainless steel appliances, the trendy white cabinets. We're really going to bring this up to snuff and up to par, which is really great. Then exterior, not much to really fix there, which is awesome. So lots to like there. I mean, as I kind of mentioned before, the big lift here that you're going to get is getting the property into the PFC program. But you basically get core plus like properties with a value add like return. And then just here's some more pictures that kind of display the luxury pool. Doug and Mickey, did you want to comment at all maybe on your experience while at these 2 properties and kind of how you felt when you were at them?
I would say these are absolutely incredible condition. We enjoyed walking them, and I mean, these are all spots where I would live in a heartbeat. Most of the projects that we end up investing in are Class B, C properties that have a heavy value add component to them. So this project was unique in the fact that we're hitting pro forma with a tax abatement versus waiting for the value add play to hit it. Absolutely. Yeah. So, and to your point, I cannot say this often, but I would feel very comfortable living in these properties. Usually, these are
not to say that they're worst places in the world, but I would feel very comfortable living here or letting, if I had a child, living at these properties as well with no fear or hesitation. So here's just a bit of the unit mix. And what this will show, and this is something that we'll probably highlight later, and when you kind of sift through it on the investor side, something to look at. But as you can tell here for Beckley, this is where the rent's at right here. This is where the rent restriction is for the 60% AMI. And then here's the 80% AMI. And then here's the market pro forma. So as you can tell, these properties really aren't getting affected by the property tax abatement, which is why this is such a generous program for us to be in, and just really an amazing opportunity that is very rare for multiple reasons. So as you can tell right here, AMI there, the rent and whatnot. So it's just really a lot to love about that. Similar for Highland, it's the same kind of setup. So as I said, for the submarket, this is in the Roslyn submarket, which has had great rent growth over the last couple of years. Yardi is projecting to be about 4% rent growth, 4.1% here. When we underwrote for our property for the market rent properties, we always we always project it to be 3% just to be more conservative. So that will be reflected upon in our underwriting. And then another thing to mention about those properties that do have the rent restrictions on them is the fact that those are based off the HUD report. So the HUD report has announced that, or updates that every year, I should say, on their income. So for 2021, it went up. We're thinking for 2022, which should be affected coming in May, that will also get a income bump as well. Think about, obviously Doug and Mickey are in Tennessee, Texas, Florida, Arizona. Those are some of the biggest net migration winners recently, which are having their incomes and for their county and stuff go up more than most places. So we do, think that there's some upside there that we're actually not even baking into the equation yet, but just kind of a teaser and a positive note that, every year we do get some natural inflation as that goes up. So as I mentioned before, lots of jobs in this area. Houston as a city is comprised of 2 loops. So this is just on the outer loop of the 2. So it's the inner loop and the outer loop. Meritage, which we'll get into in a second, is in the inner loop. And then this is on the outer loop. And as I said, this is the second best school area for Houston, which is incredible, especially when you invest. You want to look at jobs, schools, and things like that. So just a nice little factor that this deal has to offer. And we're mentioning Beckley and Highland are right next to one another, which is great. So they'll share a lot of efficiencies, and from our property management team, will make things a lot nicer for us. So here is Beckley and Highland on the map of Houston. So rent comps for this one are kind of interesting. Due to the PFC nature, these are not as impacted. We obviously looked at these without this, but this is not as important as what is going to be for the PFC for the rent comps and sales comps. Sorry, I'll turn the light on real quick. Oh, there we go. So rent comps, as I said, we property's doing well, but we're switching into the PFC. So this is not as imperative as it would be for a more down the fairway multifamily deal. Sales comps similarly, excuse me. Here's the CapEx budget, which I'm not going to go into much detail right now, but if you wanted to review it, it is in the presentation deck.
Okay, Craig, at this point, I saw the pro forma slide, and you don't have to go over it in detail, but could you explain to everyone why this tax abatement opportunity is so unique?
Yeah, absolutely. So, and thank you for that. I actually skipped over this, but as you can tell right here, putting in the abatement structure, the net operating income goes up year 1 from trailing to year 1, 40%. And that's due to the fact that we're eliminating the property taxes on this property, hence the PFC program. So just by switching into the program, we get that instant bump right here, which is pretty incredible. And then by year 2, we'll get the 13% bump. And year 3, 5.1, year 4, 3.4, and then moving forward, that's tentatively what it would be. But as you can tell, there's a big bump up there.
And we had a question in the comments. How long will you be getting the tax abatement? How long does that last?
That's a great question. So it is a 99-year long fee simple agreement. And essentially the program needs to be in place for 10 years minimum. Should we hold the property for all 10 years, which I don't think that is likely what we're going to do. Let's say if we sell it in 5 years, the next buyer can buy the property and have that in for the remainder of the lease. However, the next buyer has what's called a pilot. On exit of the property, they'll be assessed at a 15% property taxes as opposed to us being at 100%. So if you might go to the underwriting that we have, you see, the assessment at, not $0, but roughly $100,000, $200,000. That is reflected upon that. So as I said, we could be in this for 99 years, but it needs to for sure be into the program for 10 years. Does that make sense?
Yeah. And is that a very enticing, appealing thing for the next buyer to come in and purchase?
For sure. It will be, because when their lender will also underwrite the property, so we're getting this essentially at a 6.3% cap rate, which is incredible. So going in at a 6.3 cap in this market on Core Plus is essentially unheard of. And especially with positive leverage, because our debt is going to be better than when we initially thought it would be. So our debt as underwritten in actually this projection shows to be 6.1. With treasuries going down actually recently, we're having a thought that it might come in at 5.5. So that will actually impact and make our returns look a little bit better. But additionally, will just help and boost up cash flows and make everything go well. So with that said, the returns will look better and everything will be awesome.
Great.
Okay, I think you may have just answered my question, but just in case there's anything to add, with the economy on the whole looking a little gloomy over the next year or two, I feel like this project is safer and more recession resistant, which is why I'm personally investing in this one as well. But what are the factors that make it safer and more recession resistant?
Yeah, that's a great question. So some of the reasons why this is more recession resistant is, one, we're going in on fixed rate debt, which is great. So fixed rate debt as opposed to bridge debt or floating rate debt. Let's say this recession is a little nastier, longer and deeper than we anticipated, and rates go up. Well, it doesn't matter. We have fixed rate debt here, which is incredible. Secondly, let's say rents just stay stagnant. If rents are to stay stagnant, we'll still be able to basically hit as close to pro forma, if not maybe exceed that, which is great. So if rents stay kind of just stable, we're not needing a deep and heavy lift on this property where we're needing 5% rent growth and need to turn every unit down because there's big loss to lease or burning off bad debt. So with that said, there's a lot of positive factors in this deal, including, as I said, not needing 5 to 7, 10% rent growth for this to make sense, having very modest rent growth there, but additionally flipping it into the program and even staying stagnant, we would be able to get great returns regardless. If you think there's not going to be rent growth here coming up.
I couldn't agree more. And that was very appealing with this project. A lot of investments really pinned on a heavy value add lift in raising rents, and this one checks the boxes without doing any of that.
Absolutely. Cool. Sensitivities, you can tell, and this is something that you can kind of go into. We can, if you want to spend more time on that, I think on your own, but for just the 2-pack right here, the cap rate, exit, the equity multiple on this, it'll be blended together, but this is kind of what we're looking at. So we look at this stuff a lot. And if you want to play with, what if rents don't grow as much? What if, XYZ occurs? This is, great sensitivity chart and analysis that you can kind of refer back to, which might be nice if you're an investor on this one. and similarly Beckley and Highland. Now on to the podium build Meritage. So this is the third property in the tax abatement portfolio that we're offering here. This is a mid-rise property in the inner loop in Houston. It's an awesome property as well. This is construction. So essentially it's built up, and then downstairs there's a parking garage, which is pretty incredible. So this is basically a resort style living. It's pretty incredible. Doug and Mickey, did you want to comment on kind of your experience when you're at the property, and kind of how this felt to you when you were there as well?
Yeah, go ahead, Mickey. We went by this one outside of our visit to the other one that we got to go with Craig and Rob and everyone from Lone Star. So Mickey and I got to go visit this one on our own before we went to the airport, and it's just really top notch. Really think it's a beautiful property.
Cool. So the investment summary here, the great news is that, this is actually owned. So there's two different sellers in this property. So Beckley and Highland are the same seller, and this is another seller. This property is just, incredible. As you can tell right here, occupancy, 97% or 97%, excuse me, occupancy here with being built in 2008. And it's really nice because if we do elect to hold this property for a bit longer, we're not going to be experiencing, boiler and chiller issues or kind of weird deferred maintenance items that can occur with older properties that are kind of that 70s and 80s vintage range. So this property right here, being kind of the nature of it, is more of a core plus, A- property, has a slightly lower return profile, but with that and less of value add comes with definitely more of a stable property that will trade a little differently as opposed to the two garden style 90 vintage properties. So as you can tell right here, this one has a little bit lower of an IRR, but weighted together, it's roughly about 16.7%. As you can tell right here, purchase price 44 with loan there, and then very nominal CapEx on this property. So the business plan on this one is to improve amenities, put better and our management in there, of course. As you can tell, the LTC LTV right there is pretty incredible. As I mentioned before too, the interest rate here reflects 6.1%. We have reason to believe that with treasuries and whatnot being lower and actually dropping more today, that we're going to get debt closer to the 4 to 5.5 range, which is incredible, which, as I said, will only boost the return projections and whatnot. So as you can also see right here, I want to point out the going in cap rate. So in the overview section, the going in cap rate, if we were to not do PFC, would be about 4.46. With our program, we're going in at about 6.3%, which is pretty incredible. So you get an instant widening in this program, and then when we exit the property, we're going to compress that cap rate, which creates value. So this targeted IRR and equity multiple over the hold period, but that'll be a blended return profile. As you can tell, the property is just gorgeous. As you can see right here, basically a luxury resort style pool with a great outdoor kitchen area. This is kind of leading down to the gym, awesome signage in front, a really safe area. So there's about 100 units that need to be improved and upgraded a bit to bring up to par. But right here is a pretty accurate representation of what a lot of the units look like. So really nice and spacious. All of them come with a balcony. What I love about it is just the space that you have. So you have the bedroom here, a nice living and kitchen area that has an open concept feel, and then nice bathrooms and washer and dryer space. So really lots to love about that. As I said, it's one of the only places, these three would be kind of the only places I would want to live in of stuff that is in our current portfolio. So as you can tell right here, this is the deck, looks over the pool. Right here, right in that bottom left picture is actually the wine room, which some tenants use for Zoom calls or conference calls or just to hang out. The picture next to it there, on second over to the left, is actually a common space. Above it is leasing office right here. But this area is actually a extra revenue driving piece that the place has, or sorry, the building has, Meritage has, to rent out and to add additional income to the property, which is really cool and nice from just other forms of income that the property can produce. Here is some of the amenities that the place has to offer, and far bottom right picture is the outdoor kitchen setup. So here, once again, on this property, we do actually, to be compliant with the PFC, have to talk down rents, but overall, it is extremely accretive to go into the program. As Mickey pointed out before, the benefits of the NOI going up, which we will also show to you guys coming up here soon. So submarket analysis, this is in the Blair subdivision. It's in the inner loop of Houston. As I said, it's comprised of 2 loops. This is in the inner loop. The great thing about the property here, a lot of people discuss and talk about or want to be in areas that, like Austin, Texas, and like that. But a lot of folks who are investing in Austin, Texas right now, I don't think they realize this, but there's 50,000 new units and new properties coming to market. So let's say if you're an A property or an A minus, your property is going to be talked down to B or B plus. So currently at the moment, there's 0 properties in construction or in the works in this area, which is incredible. I can't stress enough how awesome of an investment that is, where you're not going to have a huge supply risk issue in your investment that will, unfortunately have to make you compete with the market. I don't know if Doug, you wanted to add anything to that, but really special that we have the ability to invest in an area where we're not going to, get destroyed by new inventory coming on and crushing our rent pricing because we don't have the latest and greatest in amenitized property. Another thing to mention as well is, I think I'll go up to the cost per unit on this property. So we're in contract for this one, cost per unit for, I believe, about 180 per unit. The great thing about this is that if we were to replicate this property with podium build, it would cost about $275,000. So almost a $100,000 delta of where we're at right now and what it would cost in addition to create something of a scale, which is really incredible. With labor prices, material prices going up, it's pretty wild that we're here and our basis is so amazing. So here's more of the Meritage by Layer subdivision. Tons of jobs, really close to the Galleria, which is kind of one of the parts of the downtown. Houston is absolutely huge, but near the Galleria, which is an awesome place to be. Every single time Rob and myself actually go to Houston, we exclusively and only stay in the Galleria. Don't know why, but it is one of the best places to be in Houston. So here is the site. As I said, the loop is right here. And what's interesting is this is the property that we're competing next to, which has a lot higher rents actually, which is great, but we're really competitive to them. So we are not trying to beat them because our PFC plan, but we're really competitive compared to the marketplace in this area. So here's another image. As I said, the Galleria is just right there. Great proximity to freeways, which for tenants to get to their jobs is great. Another thing to mention as well about the Meritage subdivision area is that the average median income in the area is about $117,000. So this is in the med center of Houston. So amazing jobs, just an amazing hub in Houston generally. So really tons to love about this opportunity considering the location and whatnot. So here it is on the greater Houston MSA map. As mentioned, we're not going to get into too much about the rent comps or sales comps, but pro forma, as Mickey pointed out before I accidentally skipped through it. Here, as you can tell, is the year one, year over year, and then the bump that we're getting just from putting it into the PFC program, which is pretty incredible. Here's some sensitivity here, which you can go through at your leisure. So I guess next steps on this one, we're looking to, well, I guess, maybe Doug and Mickey, I'll let you take it away on that side, actually, since it's these are your people.
Yeah. So as far as next steps, we have this opportunity set up in our investor portal. You can look at it, view all the documents. We'll be adding this webinar recording as well as the investor deck into that portal. You can view it. You can soft commit in the portal. And then we have, as you see below, our funding deadline is at the end of this month, April 25th. And they're planning on closing on the property in May.
Correct. And I think one thing, I don't know if I mentioned this, but for the deal itself, we're going in, as I said, once again at a 6.3 cap, and are going to have positive leverage on the deal, which is incredible. In addition, the cash on cash return profile should be about 6.8% over the 5-year hold. So I don't think I mentioned that, but once again, the cash on cash profile should be about 6.3%, or 6.8% over the hold, which is awesome.
So question on that for everyone. So if there's a preferred return component of the investment, yet the cash on cash is less than the preferred return to investors, what happens there?
Yeah, great question. So should we not be able to hit that? Our preferred return is cumulative and compounding. So let's say if our preferred return is either 8 or 9%. Let's say if we do not hit the preferred return of 8% and it's just 6% for that year, that 2% is accruing, and it's accumulating and compounding over the course of the investment.
So for everyone, that is that 2% that you didn't get gets tagged on to the next year's preferred return. And am I correct in saying there's some interest involved in there? Is that how that works?
Yeah, it accrues on the back end essentially. Mm-hmm. So the interest, but on the exit of it. So essentially the way the fees work is it's 100% of return of capital. And then it has that component of accumulating and compounding. So on the exit, we wouldn't take any fees until that 8% that is cumulative and compounding has been met.
Gotcha.
Awesome. Well, that is it on my end for the presentation. Doug and Mickey, thank you so much for having me on. If there's any questions, be more than happy to answer some right now. Sometimes people like to digest this and ask questions later, so I'm always open. But if anyone has any questions, let me know.
Yeah, well, we thank you, Craig, for walking us through all these elements of this cool investment. I think it's exciting. It's been great getting to know you and your team, and we're looking forward to doing more projects with you. Folks, the bottom line is we take your trust really seriously, but we know we got to earn that trust, and we treat your money like it's our own. And we're going to be very cautious how we help you invest it. And we're very respectful that our clients are putting their financials future in our hands. And this money is your kids' college education, their wedding, your retirement. We're never going to take that for granted. And we're just glad at this point to take anybody's questions. As we said earlier, please message in your questions via Zoom.
Yeah, and that's a really great comment you made there, Mickey. And, Lone Star, we agree with that as well. And personally, this is something that I'm going to be investing in. I'm elated to have this opportunity to invest in it. We like to do things that not only do we fully believe in, but we want to put our money in our mouth is. So to your point, we take that very seriously as well. And, that means everything to us is, investor capital.
I got a question here. Are you planning on the exit? Are you planning on selling these as a portfolio or individually?
That's a great question. My hunch would be Beckley and Highland would get sold together just due to the nature of them being right next to one another. And then similarly, I think because the Meritage property is far away, If a buyer wants to pay the highest price possible with them, those three together, by all means, that's great. However, if it makes more sense for them to be sold as a 2-pack and then Meritage individually, then that's maybe what we have to do.
Gotcha. Any other questions? Throw them in the chat if you have them. I just wanted to also comment that this program is really a great program to help people get into a really, like you saw how nice these apartments are. It helps people at a lower average median income get into a nice place to live. So it's a great program to help other people. So that's another lens to look at it through. And in a time where it is hard to find a good place to live. All right. Well, okay, here we go. Well, all properties will be under the PFC tax deferred status. State again the tax liability if it is taken out of the PFC structure. Hold times for these will be 4 to 6, and asking about the hold time.
Yeah, so we plan on holding properties for 4 to 6 years. We do not intend on leaving the PFC program due to the amazing nature of it. Let's say if in year 10, we hold it, or whatever buyer would be there, they can unwind it at their leisure, but nothing for us to worry about. We will not be unwinding this program once we're in it. So,
and another thing to add, this whole project pins on going in to the PFC status, and it won't happen if it fell out prior to closing. So like that's the whole driver of this.
additionally, all investors' capital is not risked on this at all. So you have no issue at all. So if for whatever reason this doesn't work out, it will work out, but for a reason it does not, there's no risk to the investor.
What is the, got another question. Can you restate the overall profit per year of selling in 5 years? Like, what does that mean? The equity multiple, the IRR, how does that return look?
The equity multiple should be about 2.04% roughly, with about 6.8% cash on cash return. Does that answer the question?
Yeah, I think it to dive a little bit deeper into that. So your returns that you get throughout the hold period plus the sale at the very end would equate you getting a little over a 2x return on your money over the course of that period.
Correct. So subtracting the cash flow from that and then the equity amount. So
gotcha. Any other questions? Well, hearing none, we will close this meeting out. If you have any questions, feel free to email Mickey or myself, and we will get them answered for you. So we appreciate everyone tuning in for this, and we look forward to helping you invest.
Thank you, everyone, for attending. Very nice to have you. Thank you, Craig. Thank you, Doug.